going to be covering the second part of chapter 3 in this video. Now, we covered the liquidity and asset management ratios in the first video. Now we're moving with debt management ratio. So that is what we owe, right? There are two main types of that ratio. How much do we owe, and how able is the corporation to meet their obligations, right? Three main ratios: the ratio debt to equity and equity multiplier. So that ratio is pretty simple, pretty broad, right? Total debt divided by total assets. Hopefully you remember that assets is equal to liabilities plus equity. So assets should always be greater than debt. Now, if for some reason debt is greater than assets, your financial situation is really, really, really bad. Now, do we want to have a lot of debt? Well, that's kind of like a trick question. Ideally, we don't want to have any debt yet. By having debt, we might have some tax benefits. So there's always a proper mean that corporations try to achieve. We don't want to get too much in debt because otherwise our risk is going to go up. Yet if we don't have debt, we don't use some tax benefits. So there's a thin line about that. So this one, I would say you want it to generally go down as long as it provides tax benefits. Now, debt to equity is basically for every dollar your stockholders have put into the corporation, how many dollars you owe. I would say that you want this number to go down. I don't think stockholders are happy if you pile up a lot of debt. In the event of a bankruptcy, debt holders get paid before stockholders, so that will make the corporation riskier, and stockholders will have to be compensated accordingly. Then we have the debt, the equity multiplier, right? It's total assets divided by total equity. Total assets divided by common stockholders' equity. So out of every dollar that our investors have put into the corporation, how many dollars do we have in assets, right? How many dollars? So basically that. Times interest earned. EBIT, earnings before interest and taxes divided by interest. As a general rule, we want our earnings before interest and taxes to go up. We want our interest that we pay to go down, right? We want this ratio overall to go up. That means for every dollar we owe in interest, how many dollars do we have in earnings before interest and taxes? Fixed charge coverage, earnings available to mix fixed charges divided by fixed charges, right? This will be used if you have fixed charges, right? Charges that are the same charges that you know that they're going to happen every period. You're also going to have earnings that should be available to cover those expenses. Well, make sure your earnings are way greater than your fixed charges. We want this to go up. We want earnings to go up. We want fixed charges to go down in general terms. Cash coverage. So we have earnings before interest and taxes plus depreciation. That's basically our cash flow, right? That's a way in which we're calculating our cash flow. So we have our cash flow divided by fixed charges. Now, cash flow is how much money do we actually are receiving in the corporation. So it's basically money divided by fixed charges. How many dollars in hand we have there to pay what we owe, right? If we owe a lot of money, this ratio is going to go down. If we have plenty of money, this is going to go up. Now we have the profitability ratios, okay? How much money are we making? Investors like to take a very close look at this ratio since, well, it's measuring how much are they receiving, right? Stocks are going to be very receptive and they're going to move really quickly with this information, right? Profit margin. The broadest of all, net income available to common stockholders divided by sales. Now we have net income available to common stockholders. That is the very, very bottom line, right? Once after you paid everyone else, including bondholders, including preferred stockholders, you have your common stockholders, right? If the common stockholders get a lot of money, they're happy and the price of the stock goes up. If they don't, the price will go down and you will be pretty much frowned at, right? The basic earnings power. So it measures the earnings before interest and taxes per every dollar that we have in assets, right? So it's pretty much how much are we making on assets, right? Um, Now, return on assets. We go to our same net income available to common stockholders, right? Same thing divided by total assets. We want this to go up. We want to make a lot of money based on our total assets, right? This is usually expressed as a percentage, and we want this to go up, right? We want our net income to go up and probably our total assets to go down. If they're not being productive and efficient, we might want to shed some of those total assets. Now, return on equity is very similar. Common stockholders' equity. Yes, we also want this to go up, yet this slide makes a very important point. If we have high leverage, it might be something we need to monitor. What is high leverage? Well, we have a lot of debt, right? If we have a lot of debt, our common stockholder equity is going to be relatively small, and the ratio is going to go up. Yet we're having a lot of debt. So that might be detrimental for the corporation. That will be bad for the risk that you are taking. Now, dividend payout is basically how much are you paying and as dividends. How much money are you giving out to your stockholders? Now, it's common stock dividends divided by net income to common stockholders. One quick thing: net income available to common stockholders has two potential destinations. One of them is go as dividends. The other one is being plowed back into the firm and reinvest. So dividend payout is basically what percentage of your net income available to common stockholders is paid as dividends. The rest of that money is going to be reinvested. So now market value. This is very interesting. Everything we've seen so far is based on the books. It's based on accounting. It's based on what we have and what has happened in the past. Now we are introducing market measures. Now market is based on the price of the stock. That changes every second or less than a second. It's based on public information and it's very, very sensitive, right? This is what investors believe is going on with the corporation. It takes a while to compute your financial statements. It does not take any time to adjust your market values. So one of the measures is the price earnings ratio. So it's market price per share divided by earnings per share. Earnings per share is basically how much money are we making for every share outstanding, every share that is owned by the market. Market price, well, it's the price that you will get in one of the financial websites, right? Now, do we want this to go up or down? Well, it all depends, right? What I can tell you is if this goes up, it means that the market is very enthusiastic about your corporation. Some people will classify you as a growth stock. So if your P/E ratio is high, you're a growth stock. If it's low, you're a value stock. Well, there's a lot of different financial research or financial literature that addresses these two types of stocks. In general, growth stocks tend to grow in the short run. Value stocks tend to outperform in the long run. So that's for that. Now there's another statement or set of ratios rather that is called the DuPont Analysis, and it takes into account a lot of the different ratios that we've seen so far. They're trying to figure out what is driving ROA and ROE up or down, regarding whatever is the case, right? So this is basically the DuPont analysis. You can see the formula in the book, but if we want to calculate the ROE, well, we have equity multiplier times ROA, right? And ROA on its part is profit margin times total asset turnover. So we have a lot of stuff that is going around here, right? That's the beauty of this DuPont analysis. We can pretty much dissect all of the ratios that are involved in calculating ROA and ROE and see which one is the culprit, which one is driving the ratio up or down. This is very useful for when you're interpreting financial statements and trying to figure out solutions, right? There's other ratios. The common size statements, this is called common size. You divide all of the items in the balance sheet by total assets, all of the income statement by net sales. Total assets and net sales are always, or the overwhelming majority of the times, the greater numbers in the two statements. So we're pretty much trying to figure out what percentage of every account goes to either total assets or total sales. Well, we have the internal growth rate, sustainable growth rate. You will read about that in the book. It's pretty much how much do you expect to grow, right? We're assuming different situations. Internal growth rate is if you only use your own funds. Sustainable if you use other funds, right? As I mentioned earlier in the videos or in the previous video, time series is when you compare your against yourself through time. Cross section is when you compare with others, right? Now, I don't have a slide for this, but I would like to mention the last part of your chapter: cautions in interpreting financial ratios. I'm going to put this on. Uh, Not all ratios are the same. You need to make sure that you're addressing a lot of the issues. For example, information is historical. Does that mean that that's going to happen in the future? No. Does that mean that we need to do the analysis? Yes, because it gives us a good estimate or a good idea on what could happen in the future, right? There are several ways of calculating accounts. There are several ways, if you're trying to compare yourself against a corporation in Japan, they might have different accounting methods. Ratios might not mean the same in both countries, right? Some large corporations have a lot of divisions. Think of Disney. I mean, what's their industry? Well, entertainment. Yes, they have theme parks, they have movies, they have music, they have ESPN, and so forth and so forth, right? Well, if you're analyzing Disney, well, you're analyzing a lot of stuff, right? Sometimes um, managers will try to make your statements look better than what they actually are. And that's called window dressing. There are legal ways to do it, yet they're not ethical, right? Uh, Again, there might be different